All right, today we're going to talk about the housing crisis a bit because it's coming up and I don't want you to get caught up in it. So, we're going to talk about why pricing will be seeing a crash. First of all, of course, I'm mindlessly frustrated with this camera because it's doing the mirroring thing, so I can't turn it off. Whenever they want to stop you from doing something, they bury it in 100 menus. So, depending on the phone you're using, is determining whether it's in your control to control your device. So I'll be completely frustrated with this, but never mind that. That's a fight for a different day. I do want to talk about why I keep seeing videos. Of course, there's plenty that are saying, hey, a crash is coming, a crash is coming, but some of those are just typical doomsday people who, if you say it long enough, eventually it will come. But I want to talk about statistically because the crash, I don't want people to feel like it's going to be panic in the streets, 1920, people jumping off of buildings per se. If you haven't jumped off a building already, you may jump in the next couple of years because something bad enough may be happening to you. Several things are already happened, such as rents going through the roof and people being evicted and landlords not honoring the moratorium or people being months behind and either owing a bunch of rent or being evicted, and then once they're evicted can't afford anywhere else, and of course can't go anywhere else with an eviction on the record. So for a lot of people, millions of people, the end of the world has already come. Other people who have been happy that they've watched their real estate expand exponentially in value, of course, are finding difficulties battling with uh, new property taxes and things like that because the value is paper. If you don't sell your house, it's just saying, hey, your house is worth 250,000 and now it's worth 450,000. Well, that's great till the tax man comes around and goes, well, you got a $450,000 house. Give you a new tax bill for the same house you've been living in. And that can be difficult for some people who go from $2,800 a year in taxes to $12,000 a year in taxes. So some people are facing obstacles and foreclosures and all kind of other difficulties with that. So again, that's its own type of crash, but like many others, everybody doesn't care about because it didn't happen to them. So if they're not looking for a place to rent, if they can afford to increase taxes, if they sold out and made a windfall on their real estate, a lot of them are happy as a clam. But for the rest of us mortals, rents going up, the price, getting ready to buy a house and finding that they've moved the goalpost and things like that. And then once they're done moving the pricing, of course, now the interest rates are going to catch up and really kick your dream home out of your reach. But a crash is a bit different. So a crash says like what we went through in '08. And you can check the records and Wayback Machine talked about the '08 crash in early 2007. And that's because I'm a stockbroker by trade, forex trader, things like this, and I was listening to the market issues, and I was thinking, oh my God, they've broken this thing because they were throwing money at it, and they were doing everything, and it's like that's not going to fix it. It's broken, and by spring, uh, some of the major Wall Street firms were collapsing, and the rest of '08. And what was surprising is people with way more education than I had were just like, what's going on? I mean, John McCain stopped his campaign. Barack Obama was sitting down at the table trying to figure out what to do once he becomes president. And they were like, well, everybody was in these things that they didn't understand. And a bunch of people who bought houses should have never bought houses. And it was all bullshit for the bailout because, of course, there were people that understood it. And, it was simple pieces to it. I understood it. I knew what happened. It was a shell game and it was deliberate. So, and just the short version, just so that you understand that I understand, the mortgages are bundled together uh, in real estate investment trusts. And those mortgages were put together by a bank, and then a bank would sell those as a bundle. People buy those as part of their investment portfolios, pension funds, and other kind of things like that. And they all feel like, well, if you have a bundle of them, if everybody doesn't pay their rent, then we'd have a fall. But most people, I mean, not rent, their mortgage, then we should be able to make money. They passed them on. They turned them into a security called asset-backed. I can't remember, ABCP at the time. I think that's what it was. It's going to be a little while all of a sudden, but asset-backed commercial paper, and the asset was, of course, these bundles of mortgages. But this bank would sell it to that bank, and that bank would sell it to that bank, and that bank would sell it to that bank, and nobody wanted to take the write down, and everybody would try to cash out of it at the same time as the mortgages were coming up and resetting, and people were losing their home. Now then they were just like, well, it's the government. They expanded, and all of a sudden black people could buy homes, and since black people could buy homes, that messed up everything. That's not what messed up everything. It was the adjustable rate mortgages, and when people's mortgages went from $1,500 a month to $3,000 a month, they started to struggle. $3,000 to $5,000 and so on and so forth. When those mortgages jumped, people did not understand that part. They were not able to stay in their homes. And at first, the bank said, "So what? That's the game. We'll just collect up all these homes and we'll sell them." But then they had done these arms all across the nation, and all of a sudden, entire communities, areas, regions are starting to pile on with these defaults. And now it's not pretty anymore because you're not going to make a profit on it, because all of a sudden you got a bunch of houses in the same market that are available. And then you have the regular people that are trying to sell their house, and it started this race to the bottom in housing prices. And then, of course, everybody trying to unload these worthless mortgages onto each other. And that just became an endless feeding frenzy. Took out a bunch of people's 401ks, entire pension funds, all around the world, lines around the block. But, I wrote dozens of articles in '07 about that. Even started a company to protect people from the fallout, and was put in prison for my efforts, but that's a different day. So that brings us to this one. This one's a little different. They're going, it's not '08, it's not '08, it's not '08. It is '08. A little bit further back, just to tell you a little bit about it, in 2000, 2001, I was becoming a broker, and that's when the tech bubble burst. And that's what caused '08, was that when the tech bubble burst, and it took all of these big Silicon Valley companies down in value in half and wiped half of them out, everybody went to real estate. Real estate can only go up. And then they turned that into its own slot machine, because there's stupid adages attached to real estate, like cars are a depreciating asset and real estate is an appreciating asset, and people's net worth, whites have 400,000 and people who rent have 6,000 in value. It's all paper BS to trick you into getting involved in the mortgage game or whatever else. And you don't rent, you own. Well, don't make your payments if you own it. You're not out there. You didn't buy a piece of land and chop down the trees on it and build a house. You have a landlord, and it's so and so bank. And if you don't keep paying on it, you will be evicted from that house you own. So, it's all part of the mythology and creating that idea of it. And even after you pay it off and have the title, property taxes and things like that can come in and take you out of that house you own. Eminent domain can take you out of a house you own. Don't get caught up in the mythology of, paying double for the price of a house, which is what the price of a mortgage is. As a car, you ultimately do own it. With a car, you can keep using it. It can get you another job. It can move you to another part of the country or whatever else. The house, it gets into a free fall, you're just done. You're just done. So it's a totally different game. It's a difference in opinion, if you want to see it that way. But just because someone writes one in black ink and the other one in red ink doesn't mean that's the case. So next up is what we're getting down to here, which is that, are we coming to a housing crash? Yes, we're already in the midst of it. Um, I move pretty much every year. Rents move marginally. Of course, the past year or two, they've moved exponentially. And having to do that, I'm in one of the hottest markets here in Jacksonville. The whole west side of the river is all investors. We used to go meet people. There's no individual landlords. It's all big national companies who own millions and millions and millions of dollars in multiple states and big markets like this. Jacksonville is the largest city in the country. The county is the city, and so we don't have suburbs. All our neighborhoods are integrated, and so we're part of that southern trifecta: Atlanta, Charlotte, Jacksonville. Jacksonville's really close to the Georgia border, so it's more south than it is Florida. But it's southern, but it's Florida. Now there's more southern towns in Florida than Jacksonville, of course, but uh, they're not part of that new South power like Charlotte and Atlanta. Big metropolitan areas, at least a major sports team, and because otherwise you get to naming cities all day long. You'd be like, oh, Nashville's moving, and someone's going to remind you that Arkansas is booming, and Boise, and if Raleigh, Durham, and Columbia, South Carolina. You can go on all day. That boom is nationwide, if not global. That's not a boom. The booms are certain particular cities, Boise, Austin, and places like Jacksonville. And so you're looking at a totally different situation. So on our west side, I just watched a video. It's 55%. The transactions, the houses bought, have been investors. And I can see that. I'm trying to rent, and every single one of them is like one or two or three companies. And they've set the market, and they've made it impossible for individual landlords. They've made it impossible to find a place without these exponential rents. But the reason is, now let's push the rents up on our south side, Ponte Vedra, St. Augustine, going all the way down. It's rippling through the rest of the state. But it's also a house of cards, right? As soon as they can't get $2,200 rents in this area where it should be $1,400 rents, then over on south side, where they've moved to 28 and 3200s, they're going to have to come back into the mid 2000s or low 2000s on the Ponte Vedra, on the Miami, on the Daytona, on the Tampa, on the everywhere else, because the national landlords can pull up stakes at once. They can divest out of Jacksonville. They can divest out of Austin. They can divest and just take the loss and just fill the market with dozens, if not hundreds, and they own tens of thousands of houses. And when they divest on those and create gluts in these communities, which they're going to do, because I've watched them put up houses that they bought in November and December and January up for rent for numbers that don't match the wages or the incomes or the people, and watch them drop rent by $800 in 30 or 40 days at a time. Not over a long period of time, to go from 28 to 2,000, from 2,600 to 1,800, home after home after home after home. Okay, so just to continue this ongoing war with this video, it stopped in the middle here, so I had to kind of recalibrate and reset. But as I was saying, those rents have dropped exponentially over and over and over again. And the reason we're not staying in this house this year is because, of course, they told us we're checking the comps, and we're going to move you up several $100s, and we're like, hard pass, because one, we overpaid for it already, and then you're going to go up from there. Yeah, good luck with that. So we may even pay a lot more than we would have paid here, but we're looking for bang for the buck. One of the things that we use as a guideline is, are you less than $1 per square foot on the rent? All right. So if you're over that, then I don't care what the number is, you're kind of overpriced for me, because for years, since 2013, we've been able to use that as a guideline. And it's been pretty successful, that of just a rudimentary uh, basic guideline of if a place is priced, of course, location, amenities, and things like that affected, but all other things being equal, obviously, say 2 units in the same community, um, both 1,800 square feet, one's 1,750 and one's 1,850, that one's a simplified version of what I'm explaining, but that's kind of a guideline of how we make that work. And so we're looking for somewhere a little bit more stationary to ride out the storm until we can really build the home we want to build. And that's a big difference of it, is because could have probably had a home owned, but don't want to give into that mythology. And once you pull the lever, that's where you are for the most part. Hopefully nothing happens to the market and you can sell out if you decide to grow out of that home or whatever else. But I'm way too old for a starter home. I'm way too old for intermediate type things. I'm only a couple of years out from 55 and up communities, so might hold out for that and just buy some big stretch facing a golf course near the beach. But the difference is, for a lot of these communities, once this house of cards collapses, and it's collapsing already, and when you see these investors concede, because these are not homeowners, these are national landlords. And you say, well, that's the renting community, these national landlords, that's renters. They own the properties. They're homeowners. They own dozens of homes. And if they decide to liquidate those dozens and dozens of homes in any particular community, that's a crash. That's going to create a feeding frenzy, a race to the bottom on the price, and it's going to make it impossible for anybody else trying to sell their house. Everybody that was yesterday, like on these Bitcoin commercials, my house is worth $450,000. I paid $250. It's worth $450. It's worth $550. It's worth $150. That's what happened in 2008 and 2009. People 2 and 3 and 4 years into their home selling it for half of what they bought it for, just being washed out of it. And there's a risk of that now, because the homeowners we have now, whether they be national landlords or just wealthy people, all these cash deals. It's a cash deal. They don't need your loan because they got a cash deal. Who the hell got a cash deal? Who the hell got $300,000 and $400,000 cash? Those people. And those people that can do that can write it off. They don't live there. They don't need the house. Somebody told them to help balance their portfolio. They take a bath and lose $100,000 on the house. They picked up $100,000 on the euro. It's just a wash for them. Get me out of Jacksonville. Get me out of Austin. Let's pull the plugs. They had some young upstart or somebody in their ear. Oh yeah, we could buy a house, we could flip it. A couple of them did. That was all 2020. Everybody wanted the pandemic over. It's over officially, as far as officially giving a damn. The virus hasn't given up, but everybody's officially stopped giving a damn. So that brings construction back into it. They're going to build. That puts the inventory back. That puts pressure back on the national landlords and the investors who were hoping the tight inventory was going to keep prices jacked up. And then there's a scene in Trading Places where they're trying to explain to Eddie Murphy's character in the store, I think it was in the store, how commodities work. And he just goes, oh, you guys are a couple of bookies. And I said that to say, I'm explaining this to you in plain English, because you're going to see the statistical data. You're going to see people in real estate. You're going to see the talking heads on the investment channels going, well, we're not seeing any softness or what. Motherfucker, I'm seeing the softness. I can put page after page after page on this screen right now, but I challenge you to do it. Just do a cursory search in your area on Zillow and then go into price history and watch how many times they've lowered it. Look for houses for sale and watch for $10,000, $20,000, $50,000, $100,000 price cuts. Some of them over time, some of them drastic cuts. That's not a boiling hot market where everybody's got 4 offers by noon for over 100,000 over asking. That's chinks in the armor. That's the beginning of the end. Because if every house is selling for 100,000 over asking within 2 hours, you're not going to find any houses that have been up for 30, 45 days, 60 days, 80 days, 90 days, 120 days. But you will. You won't find any reason for anybody to cut the price of their house because they're all getting 100,000 over asking. But you will. And I don't care where you live. I don't care where you see this video. I don't care where you are. I guarantee you can find it. I guarantee you can see it. I guarantee you it's there. I know it's there. So that's the beginning of it. And then you're looking at the floodgates because it's musical chairs. And all of a sudden, once anybody's spooked, you can have a large divestiture all at once. Individual investors. Because the real estate companies and brokers are just trying to keep them on the hook as long as possible. Keep buying. The water's fine. The water's fine. You know, they're just trying to keep them convinced. No, it's going up. And even if it is a bit of a correction or whatever else, it's just going to stabilize at overpriced. It's not going to stabilize at overpriced. Because the next part of it is demand. And so millennials are online to buy houses. Top of the Xers are there. You know, nobody talk about Xers anymore. But we're that sibling generation. Ranging in age from like 42 to 56. Right? So half your favorite artists, anybody you can think of, they're in their Generation X. You know, we grew up on all of that stuff in the 80s and the 90s. That's us. Right? And so Mariah, Mary J, Xer, Beyonce, Nicki Minaj, millennial. Right? That's the difference. So just right there. It's not a million miles apart. One's in their 40s, one is their mid 40s. So we're right there going through a lot of similar things at the same time. And one, you have two generations really don't care about home ownership like that, especially millennials. And Gen Z doesn't even expect to even buy a house. And so these national landlords are building brand new homes and renting them out. Have to. When I'm doing my search now, the house has to be brand new for me to rent it. Brand new house. You know, nobody else could have lived in it, or maybe a year old. This one is 3 years old. You know, because I'm slumming it. But there's no reason houses that have never been owner occupied are available for rent. But they're out there going to create a whole subclass of people who can afford a mortgage and keep them permanently as renters if they can. You know, I'm going to be paying over $2,000 a month in rent. And they're going to keep it that way if they can. But I'm not paying no attention to that. I'm buying a big stretch of land on the lake and build a house. That's the only reason I care to rent, because I don't want to cash out and get squished into another one of these planned communities. They're just plopping them down everywhere. This is in a little subdivision of other little new houses that they just plop down, cookie cutter houses. I don't want one. You have one. I don't want one. So the thing is, if you want to notice all of these things, people's wages didn't go up exponentially. And when I was talking about demand just now from Xers and millennials, it's because a lot of the extra money came from boomers who are retiring, who are buying second homes, who took the money and tried to invest somewhere or whatever else. But the Xers and the millennials are the people you need actually buying homes for families. Their second homes, their empty nests, they're this, that, and other. And they don't give a damn about it. And they just watch the house they want be moved out of reach. And you caught some of them. They just had to move the first year or so. But now they're just like, the house I wanted was $420. It's $690. Fuck off. Without that demand and the supply coming back and the investors and cash people who can divest out of all of it at any given time, when they don't see the profit being there. It's a perfect storm. Same thing on the rents. People were renting 15, 1600. Regular people are already spending 30, 40, 50% of their income on rent. And then you just go, well, then we'll just start charging 2000. They go, I don't have 2000. Especially you have rules that I have to have 3 times rent. I don't have 3 times rent. I make $4,000 a month. Right? Even if I want to, you're not going to let me go to $2,000 a month. So I can't pay you that. It doesn't matter what numbers they put on it. Then you say, well, but there's plenty of people that can pay $3,000-$4,000. People have moved from Silicon Valley. They're remote workers, blah, blah, blah. Yes, there's a finite number of them. And that's only going to go on so long. So now you still need local communities who want to live there. Everybody in San Francisco or Silicon Valley or Manhattan isn't going to move to Jacksonville. So you need culturally the people in the area to want to and to be able to pay those kind of numbers. And they don't want to. And they're not going to. So now you need the people who have the money to want to do it. And they don't want to do it because they have choices. They can buy. They can pick which community they want to be in. And you're wanting to do this much of money, they're on Zillow. They can do their research. They got time to wait. They can afford what they're doing. They're in no rush. You can't press them. If you're requiring for rent 700 credit scores and 3 times $2,200 a month, you're talking about educated people. You're talking about people with a few dollars and nickels to rub together. You can't press them. You can't rush them. They have choices. They have a 780 score and got 10 grand a month coming in. They're going to look around. They're going to weigh their options. They don't care that it's a brand new house in a planned community. Every house they're looking at is a brand new house in a planned community. What do you got that's so special? Oh, a pool in the community? It's Florida. It's going to be sunshine, a palm tree in the front yard, maybe a nice little parcel, and a swimming pool in the community. That's everywhere. That's a dime a dozen. Brand new house, that's a dime a dozen. 2,000-3,000 square feet, dime a dozen. And I'm still not giving you $2,000. And so you need those people to want to give you the money because they're not people that can't rent anywhere. They don't have any evictions. They don't have poor credit. You've asked for high-class people, basically, and you're trying to rent to them. Or you're trying to, rent your house to them. You're going to accept them. They don't need you to accept them. These are people that feel like they're shopping and you need to please them. Not, oh, you might qualify, we might accept. You can't talk to them people like that. That's how you've been talking to these people when you're charging $1,200 and $1,300. Or whatever the number is in your region. Maybe it's $800. Maybe it's $4,400. But I'm talking about relatively speaking. $1,200, $1,300 here in Jacksonville is modest. 2, maybe 3 bedroom, depending on what part of town you were in 5 years ago. Now 1 bedroom, 1,700, 1,800. That's a high number here. 2,200, it's a high number here. 29, 3,200, it's a high number here. It's still Jacksonville. And so I've given you all the elements. Demand, supply, who owns the homes, what they're trying to do when these national landlords are counting on these huge profits. It's a local company here. Well, not a local company, it's a national company, but here locally, and I'm just watching them. Dozens of houses marked down hundreds of dollars from where they started over weeks, sometimes months. Is millions of dollars in losses from their projected numbers. And projected numbers set expectations. That means the people who are invested in these companies, that means if they're publicly traded companies or whatever else, people are like, okay, you're going to be able to get 2,800, 2,500, whatever else, and then you're actually out there getting 1,700, 1,800, 2,100 instead, and you're losing an average $400, $500 per house. then that's just a recipe, clicked again, for disaster. That's just a recipe for a company to start cutting losses. And they will. And that will start to mean they start to try to sell those properties instead of trying to stay in and manage them year after year. Or they will continue to rent them at lower and lower rates, suppressing the prices that an individual landlord could get and devaluing the homes around them because they don't care about Jacksonville or Austin or whatever else, they don't live there. So whether that's squeezing the real estate market in those communities, just like it is making it impossible for renters and buyers, it can make it impossible for sellers and owners. It can make things really difficult for sellers and owners. So if you're very satisfied with yourself because you're on this end of it and saying, I'm on the good end, fortunes can change and they can flip. That's what they say about capitalism. Let the market decide. And the market is deciding that people are sitting there watching these homes, watching them cut the prices on the sale price, watching them cut the prices on the rental price, not pulling the trigger, not moving, staying where they're at, moving in with family, biding their time as the pandemic ends, as construction starts, as supply comes back, and as the pressure mounts on these investors to exit these communities. And when they do, it's a lot of money leaving and a lot of houses going on the market. So put those things together and prepare your situation the best you can. Work it strategically. If you're planning to buy a home, look at your time horizon. If you need to rent accordingly. Maybe lock in a 2-year lease if you get a good amount. Try to ride this out, or do it for a year so that you can see if the market's readjusted next year. But you got to gauge it for yourself. But those are all the legitimate reasons why there's a correction / crash coming.